Now it's time for our weekly energy update with Dan McTeague, president at Canadians for Affordable Energy.
Well, hello, Teresa, and another exciting week on the energy front. Around the world, geopolitical issues have now come back to haunt us, and to a large extent, what we're seeing this week in response to Israel's taking out of Iran's capability of building tactical nuclear missiles seems to be roiling energy markets, although not as much as one would think, probably because there's a bit of wait and see as to whether or not Iran will suffer an even greater hit, denying and preventing its ability to strike back, and not striking back Israel so much as being able to hit in the Persian Gulf. So that seems to be significantly discounted by analysts and certainly by markets who are now saying, well, oil's up $5 a barrel. We know it went up $3 or $4 a barrel on these tensions throughout the week. We also know that gasoline prices will have been affected by about 4 or 5 cents a liter and could see another 4 or 5 cent increase. But what is interesting here is, unlike anything we've seen in the past, markets remain muted. It's almost as if some, not in the markets, but in the media, believe that we're all driving electric vehicles and we don't need oil anymore. That kind of nonsense is exactly what's permeated their groupthink over the past 10 years. And it's significant because it could mean a dramatic drop in the supply of product that is used around the world. And in case one was taking note, even the woke ESG-ridden International Energy Agencies finally had to admit that world global demand for oil is only going to go up between now and 2050, continuing by 500,000 to 1 million barrels every single year. So it doesn't matter how many electric vehicles or scooters we drive or how many windmills we make. By the way, they all have to be produced as oil and gas, like it or not. The reality is that the world's going to continue to make a greater demand, not lesser demand, for high hydrocarbons. And the question we have to ask here in Canada, do we want China and India and other countries to build more coal plants? Much of that coal, of course, coming from Canada. Yeah, it's shipped from Vancouver. Not that we're lily white on these things. Or do we want to sell natural gas? And I think that's a much bigger question as far as those who are purists on the issues of climate change and carbon footprints and, how to reduce other countries, the impact other countries are having by burning the most efficient, most dense form of energy, which of course is in coal. But I digress. Gas prices in Canada, energy prices in Canada are about to see a bit of an increase throughout the week. And as we've seen right across the country, gas prices pushing a lot closer, say in Ontario, to $1.35 to $1.37. Quebec a lot closer to $1.63 to $1.65. The Maritimes pushing back into the low $1.40s. We're also looking at Saskatchewan, Alberta, and Manitoba, where we know gas stations don't like to reflect what's happening on global markets, but it's kind of hard to ignore when your wholesale price moves, in the $2.24 range. All the way up to the 240 range. Sooner or later, you have to throw in the towel because the gas you were replacing it with is much more expensive to buy by at least 10 cents a liter. Same for British Columbia. Saw prices drop as low as $1.58, $1.61, even $1.48, $1.49 in some of the places in Kamloops and Kelowna in that region. Those are all likely to move up, if they haven't already, by about 5 cents a liter, reflecting anticipation the market had of the events in the Middle East, as well as potential good news on the U.S. tariff and China discussions that are taking place in Europe. What it also means is that the next week is going to be a highly volatile week. Some are already suggesting, oh, big deal, you won't see prices go up after this. It'll plummet. I think the bears in this are going to lose the battle to the bulls, who are looking and saying, the price is not reflective of geopolitical tensions, and not just the threat, but now the real prospect that either Iran's oil will be curtailed or it will respond by choking off. And this is critical. People understand this because it's an old story, but it goes back 30, 40, 50 years. And it brought us the kind of oil embargoes and oil problems that we saw back in not just the 1970s, but also more acutely in the 1980s. When Iran and Iraq went at it in the war in 1980, where we see Iran putting a stranglehold on something called the Straits of Hormuz in the Persian Gulf, Persian Gulf is the way in which much of the oil, about a third of the world's oil is transited, and that means countries like Kuwait, the United Arab Emirates, Saudi Arabia, at least its easterly coast, and of course Iraq and Iran itself would find it difficult to now to transit through that area given the geopolitical tensions. So that really lends us to the idea that the second week of June is going to look a lot more like the kind of summers we saw in the past, where prices go up, not necessarily because of geopolitical reasons, but because of other factors. So as demand continues to be very strong, prices remain low, it's likely that we're going to see an over above increase of about 5 cents a liter this week. That also includes diesel. So fasten your seatbelts. That's best case scenario. Worst case scenario is it could be a lot higher, but we'll have more information certainly by this time next week as the world unfolds. Thanks, Teresa.